It's in poor condition, not only in the United States, but globally. The situation outside the U.S. is worse than it is domestically. The challenges at home and abroad are both of a structural and cyclical nature. I recently was able to piece together a global capacity utilization chart, and it indicates that factories are becoming increasingly idle across the globe. And this is an important concept because capacity utilization leads the unemployment rate, not only domestically, but globally. And those that have written off the worst challenges to the labor market are behind us, I believe they will be wrong. There's still considerable challenges to the labor market. We just saw today that the difference between job prospects and the positive and negative is deteriorated very significantly back to where it was last summer. And various rules that economists have developed between the unemployment rate and the inflation, although they have not yet signaled a recession, there is a very likelihood that in coming months they will. So the domestic and global economies face significant hurdles. I believe that what we're going to see is that the inflation rate is coming down. In actuality, the inflation rate is considerably lower than it's being reported because there's overstatement in the critical housing components. In fact, I think that if you do a reasonable analysis of the error for the rent component, the shelter component, and adjust for it in line with the actual prices that we have, both for sales prices and rent, the personal consumption expenditures deflator is probably running 1.8% year over year, and the CPI only 2.2. The inflation rate's not nearly as high as it seems. There was a recent outstanding analysis by the nation's leading housing experts, Barry Abebe, that presented this information. The road ahead of us is much more difficult than is generally believed. Well, I was able to reconstruct a global capacity utilization for the 5 major economic regions going back to 1990. And global CAPU leads global unemployment. What we were able to determine is that CAPU is the main determinant of your supply costs. And as capacity rises, it puts downward pressure on the cost curve for the stable items. And that is a very profound effect. In addition, we've continued to look at our detrended 4-year money growth rate, which is in negative territory. Detrended real money growth is also negative in the United States. You may say, well, why 4 years? Well, first of all, monetary policy lags are long and variable. And based upon the experience that we learned in 2020 and 2021, which was really exceptional, that when you have huge monetary explosions, such as we did, that the monetary policy lags are even longer. And so the monetary restraint is still in the system. One of the important ways that it's still in the system is that even though the Fed cut the federal funds rate by 100 basis points, it didn't materially change the critical lending rates to consumers and small businesses. According to the Federation of Independent Business, small loan rate is roughly 10%. Well, by the rule of 72, that means a small business, if it borrows $100,000 in 7 years, they're going to pay $100,000 in interest expense. And for the consumer credit cards and personal loans, even for prime borrow, the compound effect will be shorter. And there's just no way that a small business can go for an investment that's going to cover that type of cost. And the consumer is not going to have sufficient income flows to repay a credit card debt that is compounding in about 3.5 years. So those rates are too high. Another element in the picture is that by my measure, the Federal Reserve actually tightened monetary conditions further since September. And the critical variable that I'm looking at here is this modernized version of world dollar liquidity, and it continued to contract. And if you go back and look at the relationship between WDL and federal funds and the other lending rates, when the Fed was in an easing mode, those rates did come down, but world dollar liquidity was also growing rapidly. And that didn't happen in the fourth quarter. In fact, the quarterly average decline was greater than it was in the prior quarter. Historically, world dollar liquidity has grown at 10% per annum. We're now declining at 10% per annum. And when that happens, the Fed is not only draining liquidity domestically, but because we are the world's central bank, it's having a similar effect globally, and monetary growth around the world is also contracting. And the essence of the facts, and the way I look at it, is that we and our 4 major countries are in a money liquidity squeeze. And that was not alleviated by the 100 basis point reduction. In fact, it worsened in my view. monetary policy works with a long lag. The one point that I would emphasize is that as of the recent experience, the monetary policy lags are even longer when you have a huge explosion that you've never had before, and you're coming off that peak. So I would say we're dealing with a 4-year lag, but those are both now negative domestically and globally. I think it is important to put it in real terms and also to detrend for both the long-term average growth in money and also the long-term average growth in velocity. When real money growth before detrending is the same as your detrended long-term historic average, then the economy is in equilibrium. But when the real money growth, on a 4-year basis, is in negative territory, what that means, the Fed's policy is too tight. It enhances a money liquidity drain. I think that the way in which the Federal Reserve policy works really changed quite a bit when the Fed abandoned reserve requirements in the spring of 2000. And so the old world dollar liquidity looked at the monetary base plus the foreign holdings of U.S. government securities. But now what I do is I look at the Fed's holdings of government agencies plus the foreign central bank's holding of governments and agencies. And on that basis, monetary policy from its inception, if you view the world financial system as an inverted financial structure, world dollar liquidity sits at the base. And when the Fed tightens it, it not only drains liquidity domestically, but it creates a shortage of dollars and drains liquidity from the rest. We are de facto the central bank of the world. If you look back at the price specie flow under the gold standard and the rules of the game of the gold standard, basically, in modern terms, the equivalent of gold in the gold standard days is world dollar liquidity. And that's in a contractionary mode. And the Fed has not yet reversed that. And so we have a lot of monetary restraint in the system. We're working down and erasing that monetary explosion from 2020 and 2021. But the likelihood is that the latest uptick in nominal and not detrended is not an accurate reflection of the thrust of monetary policy. According to the official statistics, we've now moved back into positive net national savings. However, there are serious problems with the national income and product account, and particularly on the income side of the ledger. We saw what was a record gap in the 12 months ending March between the payroll employment data and the quarterly census of employment and wages. And then we had an even greater disparity in the 12 months ending June. Now, the QCEW is a survey of 12 million institutions. It's your full sample. The payroll data is based on a sample of 670,000 firms, and the rest are estimated off of that. And we had a record percentage deviation between the QCEW and the non-farm payroll. Already, some of the government statistical mills have stated reduced labor compensation, which in turn has reduced wage and salary income, which is will ultimately have the effect of reducing a gross domestic income. And so there are very significant reasons for believing that there are problems statistically with the national income and product accounts. So if you overstate income, and spending is as good as they say, which is also questionable, then what it means is that the saving rate is even lower than it's reported. The reported fell very sharply, which means that consumers are in a real distressed mood. I saw a recent survey that 59% of our households have less than $1,000 of rainy day money. Another thing that tells me they're in distress is because the prime borrowers are paying more than 22% for their credit card loans. This economically is very unsound. It tells me that they absolutely need to do that to get along. In addition to that, the private reporters on the consumer's credit health indicate delinquencies rose again in the fourth quarter and that the consumer loan write-offs were 50% above a year ago. Now, we don't have any alternative federal statistics that raise questions about the spending, but if the income is weaker, historically, it is more likely that the consumer spending numbers will ultimately be revised lower than higher. But even if that's not the case, the consumer is in a very challenged environment, and they've been spending in the hope that things will get better quickly, not based upon reasonable lending rates, nor based on the income that they're generating. One of the key numbers that I like to follow is the real weekly earnings of all hourly and salaried workers. In fact, I showed that chart in my keynote address, and over the last 16 quarters, we've declined at about a 1.5% annum rate. And you might recall that I also said that real average weekly earnings, which covers 120 million of us, was an election predictor. It's not an infallible election predictor, but it certainly was in November. The election also gave us another useful indicator that most people wouldn't think about. But on election day, we get the most extensive polling that anyone does in the entire year, and that's the exit polls. The sample there is double or more than what the University of Michigan or the Conference Board do, more than 4,500 versus 17 or 1,800. As people were leaving the polling booth in these exit polls, they were given 5 alternatives about how to characterize the economy. On the good side, they had good and very good. Then they had central range category. And then on the other side, they had bad and very bad. And those people leaving the polling booths, 70% said the economy was either bad or very bad. And so the folks on the ground are not feeling good. And there was a short rise in confidence after the election, a big jump in December, but it's been entirely reversed in January. In fact, the Conference Board survey out today is actually below a year ago. And why shouldn't people feel lousy? Because inflation is still high, it's coming down, but these basic necessity costs are hanging high. One of the features of the American economy is that we've been historically able to produce affordable cars and housing. They're not now. It's a residual of the accelerated money growth in 20 and 21. It's going to take time for that to work down. And so folks don't feel good about things.